economic war, which is causing America alone instead of America first. So, if you're someone who keeps a close eye on global markets, geopolitics, or simply wants to understand how power, money, and trade are shaping the world right now, this video is a must watch. So, hey everyone, welcome back to my channel. Today, we are diving deep into a topic that's making headlines across the globe and sending ripples through the financial world: the economic war that's isolating America. Let's break this down in simple terms. What's really happening, how we got here, and most importantly, what it means for the global economy and the stock markets in 2025. The slogan America First gained momentum during Donald Trump's presidency. It was about reshoring manufacturing, protecting domestic industries, and reducing dependency on foreign powers, especially China. But in the process of asserting dominance, the US entered trade wars, imposed aggressive tariffs, exited global agreements, and distanced itself from traditional allies. So let's focus on current trade policies in 2025 and their impact. The Trump administration has reintroduced stricter tariffs on all countries, including Chinese electric vehicles, semiconductors, and solar panels. These moves are framed as national security concerns and an effort to protect American jobs, but the backlash is real. The Trump administration has reimposed a sweeping 60% tariff on all Chinese goods. This has significantly increased import costs, triggered retaliatory measures from China, and fueled both stock market volatility and inflation concerns across sectors reliant on Chinese supply chains. And a new blanket tariff of 10% now applies to all imports regardless of trade agreements. This policy has led to rising prices for consumers, increased cost for manufacturers, and growing fears of retaliatory tariffs from global partners threatening global trade stability. The US has begun disregarding unfavorable WTO ruling related to tariffs. This move undermines international trade law, shakes investor confidence in trade predictability, and the risk encouraging other nations to bypass global rules as well. So, efforts to finalize trade agreements with the EU and Canada have stalled. This freeze has strained key alliances and could lead to a decline in bilateral investment flows, creating uncertainty for cross border businesses. To bring manufacturing back to the US, the government has introduced tax breaks and subsidies for domestic production. While this is expected to support local industries, it also raises production costs and forces a gradual realignment of global supply chains. There is a fresh wave of restrictions targeting Chinese tech companies, especially in the semiconductor and hardware sectors. These measures are disrupting tech supply chains and putting downward pressure on technology stocks tied to global production. Certain allies like Taiwan, Israel, and Japan are receiving selective tariff exemptions. While this shows strategic favoritism, it also introduces inconsistency in trade policy and creates an uneven playing field among US allies. The US has enforced stricter country of origin labeling laws to promote domestic goods. This policy increases regulatory burdens for businesses but aligns with political goals of revitalizing US manufacturing. Shifting away from multilateral agreements, the US now favors bilateral trade deals. This weakens its leadership role in global trade institutions and opens up space for the major players like China, India, and the EU to assert more influence. And this is where the concept of America alone comes in. While Trump's 2025 policies echo his earlier America First strategy, the geopolitical climate has shifted. The world is no longer waiting for the US to lead, it's adapting without it. So now in 2025, we're seeing the aftershocks of those decisions. The same policies that were meant to strengthen Americans' economy may be isolating it. So let's understand why. Because globalization did not stop when America paused. Other nations moved on. They formed new trade blocs, fostered bilateral ties, and built alternatives to American influence. So while the US doubled down on tariffs and economic nationalism, others diversified. So, in response to shifting global trade dynamics and the Trump administration's aggressive trade tariff policies in 2025, several countries and regions have taken strategic actions to safeguard their economic interest. The European Union, in a landmark summit held in Samarkand, announced 12 billion investment plan aimed at strengthening trade, energy and digital ties with Central Asia, signaling a clear move to diversify away from US influence. Argentina is proactively seeking a trade deal with the US to soften the potential blow from Trump's looming tariffs. Meanwhile, Vietnam, India, and Israel are engaging in negotiations for tariff exemptions or new bilateral agreements to shield their exports. Thailand is advancing free trade agreements with EFTA and the UAE and Sri Lanka to open alternative trade routes. Additionally, the Regional Comprehensive Economic Partnership, which has been active since January 2022 and includes 15 Asia Pacific countries, continues to boost regional economic integration, covering nearly 30% of the global GDP. All of these moves comes as a direct response to Trump's 2025 trade decision to impose a 60% tariff on Chinese imports and a blanket 10% tariff on all other nations, prompting widespread backlash and accelerating the formation of new global trade alignments. And now, many experts argue America isn't the leading global economy anymore, it's just playing catch up. So, how is all this impacting the stock market? So, here is what we are seeing: increased volatility in US equities, especially in sectors tied to exports like tech, autos, and agriculture. The first 4 months of 2025 have seen heightened volatility and downward pressure across global stock markets, largely driven by escalating trade tensions and economic uncertainty. In January, the announcement of a 60% tariff on Chinese imports by the Trump administration led to a sharp market declines, with the Dow falling to 2.7% and the S&P 500 dropping 2.3%, while the VIX surged from 21 to 34, signaling increased fear in the market. The tech and consumer goods sectors were hit hardest, reflecting investor anxiety over a renewed trade war. In February, China responded with retaliatory tariffs on US goods, which further rattled markets. The Nasdaq slumped 3.4%, with heavy losses in semiconductors and agriculture due to renewed supply chain disruption concerns. March brought additional pressure as global central banks issued recession warnings, causing S&P 500 and India's Nifty to fall further. The VIX climbed to 40, its highest point so far in the year, indicating sustained market stress. In April, the situation intensified as Trump proposed extending tariffs to imports from Mexico and the EU, leading to a broad sell-off in global indices, particularly impacting the auto and pharma sectors. Overall, from January to April 2025, the S&P 500 has declined tremendously, and same with Nasdaq, while the volatility index has averaged above 30, a clear indication of ongoing market turbulence driven by trade policies, inflationary pressure, and the recession fears. What's next? Multinational companies are under pressure as global supply chains get disrupted again. In 2025, multinational corporations across diverse industries are experiencing widespread disruptions due to the ripple effects of trade wars, tariffs, and global supply chain imbalances. Apple reported a 6.3% year-over-year drop in Q1 revenue, primarily due to tariffs on Chinese imports and semiconductor delays. This has forced Apple to reduce iPhone production by nearly 10% and shift parts of its assembly operations to India. Tesla, meanwhile, has been hit hard by increased tariffs on Chinese battery components, resulting in delivery delays across Europe and Asia, and a 12% rise in raw material import cost. Samsung is also grappling with challenges facing freight bottlenecks across Asia that have led to a 28% increase in inventory and a 7% drop in sales, putting pressure on its cash flow. Similarly, Nike has reported a 4.8% decline in global revenue for Q1 2025 due to new EU tariffs and significant shipping delays, while Europe bound shipments delayed by an average of 3 weeks. Boeing is struggling with the production backlog of over 230 aircraft, primarily due to tariffs on metals and logistic delays affecting aluminum sourcing. FMCG giant Unilever is contending with rising inflation and supply bottlenecks, particularly in Africa, resulting in a 9.1% increase in operational cost and a 3.4% decline in profit margins. Lastly, Intel's expansion plans have taken a hit, with delays in importing chip making equipment causing a 5% downward revision in their 2025 revenue guidance. The Ohio chip foundry construction, a key project, has been delayed as a direct consequence. Collectively, these disruptions highlight how geopolitical tensions and trade policies are deeply shaping global corporate operations and financial outcomes in 2025. What next? Emerging markets, especially in Asia, are benefiting from new trade routes and agreements that exclude the US. In 2025, a way of strategic trade realignments is reshaping the global economic landscape, with several emerging Asian economies capitalizing on regional trade blocs that notably exclude the United States. Vietnam is a standout performer, leveraging its participation in the Regional Comprehensive Economic Partnership and the EU Vietnam Free Trade Agreement. These agreements have propelled Vietnam's export up by 11.5% year over year and attracted $23 billion in foreign direct investment. The country has rapidly become a major alternative manufacturing base to China, particularly in electronics and apparels. Indonesia is also benefiting from RCEP and its Asian-Japan Comprehensive Economic Partnership Agreement. The country's GDP growth has been revised upward to 5.7% for 2025, driven by a boom in nickel exports and growing demand for EV battery components. India, on the other hand, is seeing gains through bilateral agreements like the India UAE CEPA and ongoing talks for India EU FTA. The country has reported a 4.3% rise in service exports and a 9.2% increase in industrial exports, with pharmaceuticals and textiles leading the surge. Thailand is on track to deepen its global trade presence with RCEP and pending entry into the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. The country saw an 8.6% increase in automotive parts exports, bolstered by infrastructure development in its Eastern Economic Corridor. Malaysia, a member of both RCEP and CPTPP, is seeing its electrical and electronic exports soar by 12%, while its GDP is expected to grow by 4.9% as it strategically diversifies away from the dependence on China and US. The Philippines, another RCEP member, is witnessing a 7.8% rise in BPO and electronics exports. Meanwhile, Bangladesh is growing its global footprint through preferential trade deals with Asian countries. Garments exports are up by 9.4%. So, collectively, these countries are strengthening their economic ties and trade positions through regional alliances, capitalizing on the vacuum left by the US retreat from multilateral trade partnership. Investors are nervous. Tariff talk and economic isolation spook the markets. Every headline about new tariffs, countermeasures, or supply chain decoupling causes swings in the Dow, Nasdaq, and S&P 500. The perception is shifting from America being the economic epicenter to being a protectionist island. So, why this matters to everyday investors? You might be thinking, okay, cool, but how this affect me? Well, let me tell you. If you invest in the stock market, you need to understand that tariffs reduce corporate earnings and that hurts stock prices. If you are a consumer, tariffs often lead to higher prices for goods, from cars to electronics to basic commodities. If you are a global investor, you will see more and more companies shift manufacturing and sales away from the US, and that could shift economic power over time. And most importantly, if you are trying to build long term wealth, you must understand how economic policies shape the markets. We are living in a world where geopolitics is equivalent to portfolio risk. So, what to watch next? So, what should we keep an eye on as 2025 unfolds? Tariff escalations, especially between the US, China, and the EU. Global supply chain rewiring. Watch where companies are moving operations. Emerging trade blocs like BRICS, Asian, and African free trade zones stepping up. Currency fluctuations. Isolation can lead to a weaker dollar in the long term. Tech and EV sectors, heavily exposed to both US and foreign retaliation. The world is changing fast. We are no longer in a unipolar world where America calls the shots. In 2025, trade wars don't just impact two countries, they trigger global consequences. America first might have sounded patriotic, but America alone could be the reality if economic nationalism keeps building walls instead of bridges. So, as investors, learners, and citizens, we must stay informed because the next big market move might not come from a company's quarterly earnings, but from a presidential tweet, a new tariff, or a geopolitical handshake elsewhere in the world. So, thanks for watching, everyone. If you found this video insightful, please hit that like button, subscribe for more breakdowns like this, and let me know in the comments, do you think America's current economic policy is helping or hurting its global influence? I'll see you in the next one. Until then, stay smart, stay curious, and stay financially fearless.